I've been a day trader for the last 8 years, and here are the 5 rules that I never break. And guys, this is not going to be some fuzzy, imaginary advice where I'm gonna tell you go and get more disciplined, like train your psychology, etc. No, let's get rid of that bullshit and talk about the real advice, real highly applicable tips that I'm gonna give you today that you can get right now, go tomorrow and apply it. No matter what kind of trader you are, no matter what strategy you trade, these are gonna work for you. So make sure to stick till the end of this video. We will break down all of them one by one. And by the way, guys, this is the first yapping video that I'm doing on this channel without any script. I just got my phone and a couple of bullet points that we will be breaking down in this video. There's going to be no cuts, just one video, and we will cover everything. So, without wasting time, let's get into the first bullet point. Rule number 1. And ironically, that rule is about using only one time frame and one pair ideally. So, in this world where every guru on the internet is telling you, you have to make the top-down analysis, you need more than one time frame, you need the higher time frame confirmation, you need the lower time frame entries. So, what is the top-down analysis itself? Why they are pushing this idea so hard? First of all, the top-down analysis is when you analyze the charts on the higher time frame, find some of like the key levels there, and go into the lower time frame, wait for the price to reach that higher time frame level on the low time frame, and try to find an entry. Why do we do that? We do that because we want a better win rate. Like you have a higher time frame which is stronger than the lower one, which is the first misbelief that the traders have. And we think that if we're gonna take the higher time frame and wait for the confirmation on the lower time frame, we are going to have like the bigger risk to reward ratio trades. Like on the higher time frame, you're gonna have 20, 30 pips stop loss, and your take profit is going to be like 50, 60 pips. You're gonna take 1 to 3 hour trade. But on the lower time frame, if you go to the 1 minute and catch a reversal, you're gonna catch 1 to 20 hour, 1 to 30 hour trades. And that is, guys, that is absurd. Let me tell you why. Because I have lived over all of that for the last 8 years. I remember 2020, it was the time, 2019 actually, you know, those times it was called like the Wyckoff method, read the footprints of the banks kind of stuff. We were told that all of that bullshit, like you find a level, you go to the low time frame, look for the confirmation, etc. So I had a couple of problems with that. When you are trading the higher time frame level on the low time frame, we know, of course, the price is going to go and touch your higher time frame level. That's a fact. But the problem I had, at least, I never knew when. Probably you can agree with me on that. Because you have a higher time frame, you wait, the price might go into your level, like it might be consolidating the whole day, it might be consolidating for a couple of days, and one day during the night, when you were sleeping or you were eating, having a love with your partner, or like shitting at the toilet, the price is going to go and touch the higher time frame level. And ironically, most of the times when that happened, I was not in front of the charts. The price is going to get into that level and reverse from that without me. And I was like, oh my God, I was waiting for this moment for a couple of days. And the price simply went to my level and never gave me an entry because I was simply not in front of the charts. And you might think, okay, I'm gonna put some pending like the alerts, something like that. But guys, that is not going to work. You might not have the internet, or simply to make a profitable decisions, you should have sharp mind. So this is not going to work. That was the first problem. And the second problem, the second half of the time, when the price would actually go to that level and I would actually be in front of the charts during that time, the 50% of the time, the price never gave an entry. Simply, the price would go to the 4 hourly time frame supply level, let's say. It will tap and it will reverse. Even on the 1 minute time frame, I will not get any confirmation, any market structure shift, any change of character, nothing. And I'm like, damn, the price achieved my level and didn't give me confirmation. The half of the time I'm not there, I'm sleeping. And the other half, the price is simply not giving us an entry, a confirmation on the low time frame for what we actually need the low time frame. So the level of absurdity of the higher time frame analysis is crazy. That is why, guys, you have to stick to one time frame, only one. And for this advice to be highly applicable, you answer me what type of trader you are. There are only three major types of traders: scalpers, day traders, and swing traders. Of course, there's a fourth type, which is investor, but guys, we're not investors here, we're traders, and we want to take trades, make speculations in the market. So if you're a scalper, you have to stick to the 3-minute, 5-minute time frame. So you're gonna be trading on the 5-minute. All of your levels you will be finding on the 5-minute. All of your entries will be on the 5-minute. That's it. No need for the confirmation, no need for anything. If you're a day trader, your levels are going to be on the 15-minute time frame. And you're trading, your battleground is on the 15-minute time frame. All of your analysis, all of your entries on a single 15-minute time frame. And for the swing traders, the 4-hourly time frame works best. Coming back to the second part of the rule, which is trading only 1 to 2 pairs. Guys, there are dozens, hundreds of different instruments on the market. Like you can trade Forex, you can trade indices, crypto, stocks, and all of that stuff, all of these instruments, they all have their own character. Like I do trade the OP investing methods, and even the OP investing methods, they work the best on all the major Forex pairs. They work on indices as well. They work on the gold, but they don't work on the gold, sorry. They work on the crypto. But even the same strategy that I trade, it is going to work a little bit different on the different instruments. So every instrument that you're going to trade is going to have its character. That is why I advise everyone who's starting out, just choose 1 to 2 pairs, backtest it for at least 1 year and learn it. And then you can go and choose more pairs. And most importantly, guys, this is a very interesting part. Most people will trade the correlated pairs, like let's say EUR/USD and the GU. And they're gonna think like, we are trading 2 different pairs. When in reality, these pairs are highly correlated with each other. When the EU is going to up, the GU is going to go up in a slightly different manner. As I told you, different characters, different attitudes to the market. And the same with the stocks, like your indices, like you're trading the spider, you're trading the like S&P, they more or less move in the same direction, in the same manner. I need to take a drink. As Tate said, sparkling water. So this is the end of the rule number 1. Let's move to the rule number 2, which is maximum of 2 trades a day. Actually, you don't have a problem, any psychological problem. You are good enough already to become a profitable trader. You're not greedy. You simply don't know how many trades you're supposed to take. And that comes from not knowing how many trades actually are presented by your trading strategy during a day. So for this rule to be applicable, first of all, you need a highly mechanical strategy. For example, I do trade the OP investing method number 1, for example, that is the breakout from the Asian range. We take the first 4 hours of the Tokyo session and we wait for the price to break out to the upside or to the downside during the London or New York sessions. It happens during either London or New York. So basically, our strategy presents our only 2 opportunities per day. 1, we might have the breakout and retest to the upside. Second, we might have the breakout and retest to the downside. Only 2 trades. For example, if the price broke out to the upside, retested, the trade is gone. There's not going to be the second chance to enter the longs when the price will come back to retest the Asian range. That opportunity is already gone. So first of all, you need 100% mechanical strategy for that to work. And secondly, let me give you a highly applicable tip that I have promised to you. And that comes back to the type of trader you are. First, the scalpers, you are going to have the maximum of 1 to 2 trades per session. For example, you're going to trade the opening of the London session or the opening of the New York session. For each opening of the sessions, you are allowed to take only 1 to 2 trades maximum. When you have your hard limit, you're not going to be greedy, you're not going to be over trading, you're not going to be revenge trading. All of your psychological faulty things in your head is going to work out and it's going to get amended. So that is why this is a second rule. Never take more than 2 trades per day. Let's move to the rule number 3, which is exactly the time reference. And as you remember in the rule number 2, I've told you that you need a 100% mechanical strategy. And a lot of people ask me, Islam, how do we actually create a mechanical strategy? What's the difference between the real mechanical strategy and the so-called mechanical strategy? Because everyone on the internet, every guru that you see is going to pretend, is going to tell you, is going to swear you, is going to tell you for the God's sake, like I do have 100% mechanical strategy. It's all rule-based. It is replicable. It is tradable. That all of that is bullshit. Unless that strategy do have a time reference. For example, again, they might be telling you like you need to take your trades on the supply and demand, or you need to enter on the order blocks, fair value gaps. They're going to teach you the rules, how to identify the clear rule-based fair value gaps. Fair enough. I don't have a problem with that. But when you open the chart, first of all, you don't know what time frame you have to trade. Second of all, they're going to tell you that you have to do the top-down analysis. So simply the potential opportunities, the number of fair value gaps or the order blocks on the chart, it's going to be unlimited. They're going to tell you, bro, you have to start on the weekly time frame, all the way up down to 5-minute time frame. So how the order block on the weekly time frame is going to help you. And you have the order block on the weekly, on the 4-hourly, on the 15-minute, on the 5-minute. There are dozens of them. Which one you have to trade? Nobody has an answer. So that is why to make your strategy, your levels 100% mechanical, you have to introduce the time element. How? Let's come back to the rule number 1 when we've talked about the type of traders, etc. And I've told you about my breakout and retest strategy. So look, here's a really good example. And I will give you more examples about the supply and demand, how it can be turned into the fully mechanical strategy as well. But first of all, let's think about the first 4 hours of the Tokyo session. The range. As we all know, the Asian session consolidates, the London manipulates, and the New York session distributes, right? So as we know, the Asian session is the quietest time of the day. We drove the highs and the lows of the price action during the first 4 hours of the Tokyo session, which is going to be the reference point. And that reference point is 100% mechanical. It's the same for you, for me, and for anyone else. Even your grandma, if you give her a correct instructions how to find the first 4 hours, she can do that by using the simple sessions indicator. It is going to be the same. Whatever, you live in US, you live in Australia, you live in Europe, Asia, China. The first 4 hours of the Tokyo session are the same. The beginning of the London session are the same. So we do have the reference point, the first 4 hours range. We have to trade the breakout and retest. It is going to be the same for you, for me, and for anyone else. We have the same range, we have the same starting point, and we have the same session open, which is London and New York, which are the same for you and me. Does it make sense so far? So this is exactly how you make any strategy mechanical. First of all, the biggest point of a mechanical strategy is that 2 different people using the same strategy should be able to trade the same stuff, like should have the same levels. Because if you ask like 2 different traders to mark up the order blocks on the charts, 2 of them are gonna mark up 2 different levels. And both of them are gonna be right, most interestingly. And this was about the trading the breakout and retest. Let's talk about the supply and demand levels, about the key levels, how you're able to make them 100% mechanical. And for that, as we taught, as I told you, there are dozens and dozens and dozens of levels from the past. And all of them are literally irrelevant for the market. The only way to make this 100% mechanical, to clear out all of the noise from the past, which is irrelevant, because the older the level is, the more irrelevant it becomes. Probably you heard about like, you have to trade the fresh supply and demand zones. Of course, right. I 100% agree with that. And as I told you guys, let me give you a highly actionable tip. Here, tip number 3. So, to find the levels 100% mechanical, again, we come back to the type of trader you are. For the scalpers, it is going to be the previous session. So for example, you're a scalper, you trade the London Open, you have to mark up the previous Asian session, the Tokyo session, and look for levels only inside of that time plus price reference. Anything older than that is not relevant for you. Doesn't matter. Let's say you're a day trader. Your reference point is going to be the previous day candle. You're going to go into the previous day candle, mark up it like the high and the low. You have a range. For example, today the price just started out somewhere around here. You have a whole previous day candle here. And there is going to be just a handful, just a couple of supply and demand, order blocks, fair value gaps. Doesn't make sense because you're trading on the 15-minute time frame. On the 15-minute time frame, the previous day candle is still valuable to trade, but it is compressed enough. There's no like too much information. You're going to have a maximum of 2-3 levels. Like the previous day high, previous day low are one of the levels, and there's going to be like 1 to 2 order blocks or swing high, swing lows that you can trade for the reversal inside of the previous day candle. And the same applies for the swing trader, which is going to be your reference point for finding a key supply and demand levels that's actually gonna reverse the price is going to be the previous week candle. All of your levels are inside of the previous week. Anything older than that, that is already irrelevant. Don't look at that. This is how we're going to make trading the supply and demand levels 100% mechanical and with a time reference. This was rule number 3. Whatever strategy you trade, just apply it and you will thank me later. And the rule number 4, target 3 to 5 R. Never chase 1 to 10 R trades. Okay guys, first thesis here is that the win rate and risk reward ratio are negatively correlated. Look at that. Why the SMC ICT traders lose a lot of money? Like, have you ever thought about that? It is, and if you go and audit their trades, their trading journal, or their MT5 stats, you're gonna see that majority of their trades were in a good profit once. They've got like 5, 6, 7 R. I lived that. I had that myself. So I can confidently say that. A lot of their trades gave them a decent profit that they never closed. They were waiting for 10 R, 20 R trades. So this is a law in trading. The more you aim to win, the less likely you will ever reach that. So that means the higher your take profit, the bigger risk reward ratio you're aiming for, the less likely you're going to achieve that. And like your win rate is going to be very low. Like you will be winning only 5%, 1 out of 20 trades. And you might be thinking, okay, like I'll be winning 1 out of 20 trades, but that one trade is going to be like 50 R trade. It is going to be cover all of the losses and I will just double my account, okay? But there's one problem. Your psychology will not be able to handle all of that. After how many trades, after how many losing trades do you go and start adopting your strategy, adopting yourself, adopting your own ability to trade the markets and start tweaking things? Like maybe my strategy is not working. Maybe I have to choose a little different supply and demand zones, order blocks, fair value gaps. Maybe I have to use this indicator, add this more confirmation. All of that are going to, like, you're going to be tweaking your strategies. Tweaking the strategies will give you completely different results, and doing different things all the time, it is not going to give you a predictable outcome for your trades. Because if you want a predictable outcome in trading, you need to make the same thing, predictable things over and over again. that is when you will let your edge to play out. And on the other hand, after testing like thousands of trades, I found out that the best win rate is anything above 50%. 50% is good enough. Like when you lose one trade and win one trade, this is when your psychology, your brain will be able to operate consistently without doubt, with confidence in your strategy. So you have to aim for 3 to 5 R, not 20. I remember that I have promised you to give highly applicable tips, and for taking profits, I do have a highly applicable tip as well. Whatever strategy you're trading, whatever type of trader you are, you can get this, something that I'm going to tell you right now, and go and implement it right today. So take a pen and paper and take notes. First of all, let me give you a little story how I came up with that. Like in the past, I had the same problem. Like I've blown many accounts, and one day I was sitting with my mentor and he told me, okay, bro, you fucked me up. Like get your damn like trading book. Where's your trading diary? Or what was that? I said, what the hell is that? Like, I promised you that I will be journaling every my trade, but I never did. So he told me, okay, fuck it. Get your MT5, open your MT5. We're going to go after each trade one by one. And we have rewinded like 3 months of information with him. And it was interesting that out of 100% of my losses, 40% of them went straight into the stop loss. Like I was wrong at that time. But the other 60% of my losing trades, they actually were in a decent profit. They were like 20 pips, 30 pips profit before reversing back and hitting my stop loss or hitting the break even. Like if I only could take profit at the right time, I would have been a massively profitable trader. So I didn't have any problems with my strategy. I had the problem with taking profits. And taking profits is actually where the profits are made. We're all obsessed with a stop loss, like, it's your stop loss, protect your capital. Bullshit. You need to know how to take profits. So, and when we analyzed, as I told you, the profits were like 20, 30 pips, and he told me, there's an indicator which is called ATR. Probably you know that. Average true range. That indicator takes the average of the last 10 days of the price action. Like, let's say the price moves like 50 pips yesterday, 60 pips the day before, the 70 pips the day before that. And it takes like the numbers for the last 10 days, 14 days, whatever you're gonna just tell it. And it's going to divide it, like it's going to find the average. So that's why it's called average true range. So the average true range for any Forex pairs that I used to trade was around like 60 to 70 pips a day at that time. So he told me like, just aim for the half of that ATR number. That's all. Interesting, right? And it was like I became a profitable trader overnight. That's interesting. So you have to take the ATR indicator, go to TradingView, find it, and you have to use on the relevant time frame based on the type of trader you are. For the scalpers, that is going to be on the 4-hourly time frame. You go to the 4-hourly time frame, take the number the ATR is showing you like, let's say 30 pips. You're gonna divide that by 2, it's going to be 15 pips. Any trade you take must be aiming that 15 pips target, not more. It can be less, but not more. If you're a day trader, you're gonna go into the daily time frame, use the ATR number, get the number, and that is going to be your take profit. Let's say you're a day trader, like on the day trading EURUSD, the ATR is like, let's say 70 pips. So your take profit can be maximum of 35 pips, not more. It is simply the safest place. Maybe it's going to go like 50 pips. But statistically, the price only goes up to 70 pips. But you have to understand, the moment that you're entering the trade, the price already moved some pips. It already had some sort of like the range, and it's probably the 35 pips. So you have a room of 35 pips above and below of that price range. Think about that. So, and for the swing traders, again, like you're gonna go to the weekly time frame, open the ATR, take the half of that number, and that's all. And in the past, I was aiming like 100 pips, 150 pips during a day. When the pair, the instrument only moves 70 pips for the whole range, from the bottom to the toe. And I was aiming for 150 pips. it is not logical. I'm a day trader. I have to close my trades during a day. I'm not a swing trader. If I'm a swing trader, I have to trade on the higher time frame. So that was the absurdity, and that was a simple fix that you can take now and implement into your trading. And I can guarantee your win rate is going to get a lot better. This was rule number 4. Let's move to the rule number 5. Never change a strategy before 100 trades. Most people quit after 5 losses. That's variance, not an evidence. This is going to be the biggest psychology lesson about trading that you're ever going to learn. First of all, there is no a holy grail in trading. There is no strategy in the world that is going to give you a 100% edge over the market. And secondly, you cannot understand the price. Literally, all of that scam, ICT, SMC, reading the footprints of the banks, they're focused on trying to follow the price action. What does it mean, like, to follow the price action? It means like, okay, I can read the markets, I can understand what it's going to do, but there are millions and millions of participants in these markets. Tomorrow, the Iran is going to like drop a bomb. Like, how do you know? Will it drop it? Like, and after that, the USD is going to go like, there's going to be a lot of volatility in the markets. And you don't know, like, unless you're an insider, you cannot know where the price is going. It's all bullshit. It's all probability game. It's all random. But what you can do in the markets and how you can actually make profits is by knowing about the probabilities and knowing and having an edge over the markets. It is not possible to predict the next move of the market, but you can do that over the sample of 100 trades. Let me give you a clear example. Imagine there's a box and there's 100 balls. 50 of them are green and 50 of them are red. You can pull a one ball at a time blindly without knowing what kind of color it's going to be. If that is going to be red, you're gonna lose $100. And if it's going to be green, you're gonna win $200, $300, let's say. Do you know what is going to be the color of the next ball? Of course, no. But if you do that, if you repeat that 100 times, yes, 50 of them are green, 50 of them are red. The same that we aim for in the markets, 50% win rate. So if you're going to pull out 100 of them, at the end, you will be 10K in profit. You're gonna lose 5K on the 50 balls and make 15K on the green ones. Overall, you're profitable, even if you don't know what is the next move of the markets. That is called an edge over the markets. And you cannot judge your strategy based on the 5 trades. What do all of the traders do? And I used to make that as well. I used to take 10 trades, 20 trades, and that's exactly why the ICT and SMC doesn't work. You're gonna have a lot of losing streaks, like 10 trades, 20 trades. After that, your confidence is going to get shattered. And what you're gonna do? You're gonna run and change your strategy. Add more confluences, tweak it, delete something, or without the confidence, you're going to say, okay, maybe I have to pass this trade. It doesn't look good. And you stop actually mechanically following your strategy. That is why, first of all, you have to choose the valid, real strategy that has a real proven edge over the markets. And then after the strategy is chosen, you just need to stick to that strategy no matter what happens. At least 100 trades. And when you put that into the perspective, during a year, if you're a day trader, there's going to be, if I'm not mistaken, there's going to be like 250 trading days. Something like that, or even less. So to forward test, like even if you have day trading doesn't mean you trade every day, and day trading doesn't mean you take a couple of trades a day, maximum 1 to 2 as we told, and you're going to have like 2 to 3 times a day, like 2 to 3 times a week days in a week that is going to present you with the opportunity to trade. So to test out, to forward test yourself in the live markets, a strategy, it's almost going to take you a handful of almost a full year. So first of all, you need to take a strategy. You need to find a proven edge over the markets. You need to backtest that with the hindsight data, and then you have to forward test in the real markets with the real money, which is going to take you again at least 1 year. Deviating from one strategy during a year, that's the worst thing that you can do. Because the strategies are not the problem. You are the problem because you're not letting the edge to play out. That is why you have to know about the strategy. You have to choose the right strategy, the proven one, and stick to it no matter what. Okay, folks, let's recap everything that we have talked about today. You have to choose one time frame, one pair every single day. Second, you have to take maximum of 2 trades per your session, per day, per week. No exceptions based on the type of trader you are. Third rule, no time reference, no trade. Now you know how to make from any strategy a mechanical strategy, a rule-based strategy that's going to have the same rules for everyone. Fourth, you have to target maximum of the 3 to 5 hour per trade. That's exactly when your win rate is gonna skyrocket, and you will probably, if you're a break-even trader or slightly unprofitable trader who are thinking like, what the hell is holding me back? I know everything. Probably this point is going to change everything for you. You need to set right take profits, because it's even much more important than your stop loss. And rule number 5, never change a strategy before 100 trades. Guys, this was the 5 non-negotiable rules. And if you want to learn how I do personally trade, or you need my personal help to achieve consistency and profitability with trading, check out the first link in the description and watch this video next.